Silver has always been one of the most misunderstood assets in financial markets. In 2026, silver is no longer just a precious metal. It sits at the intersection of inflation protection, industrial demand, monetary policy shifts, and speculative capital flows. Many investors focus on one question only: will silver go up or down? Professional investors ask a very different question. How much risk does silver carry at current levels, and when should capital rotate away? In this analysis, we will examine silver in 2026 through the lens of professional risk management, exit discipline, and capital rotation, explaining how experienced investors think about silver not as a belief, but as a position. Introduction: Why silver demands discipline. Silver behaves differently from most assets. It is part commodity, part monetary hedge, and part speculative trade. This hybrid nature creates opportunity, but also volatility. Historically, silver moves faster than gold in both directions. Gains can be rapid, but drawdowns can be severe. For that reason, professional investors never treat silver as a permanent holding. They treat it as a cycle-driven asset. Understanding silver in 2026 requires understanding macroeconomic conditions, liquidity flows, and investor behavior. The macro backdrop for silver in 2026. Silver performance is closely tied to three macro forces. First is inflation expectations. Second is interest rate policy. Third is industrial demand. In 2026, inflation remains a structural concern rather than a temporary shock. While headline inflation may fluctuate, underlying cost pressures persist across energy, labor, and supply chains. At the same time, interest rates remain higher than the ultra-low environment of the previous decade. This changes how investors price non-yielding assets like silver. Silver benefits when real yields decline. It struggles when real yields rise. Professional investors continuously monitor this balance rather than relying on price trends alone. Industrial demand and structural support. Unlike gold, silver has significant industrial usage. Key sectors include solar energy, electronics, medical applications, electric vehicles. In 2026, global energy transition efforts continue to support long-term silver demand. However, demand growth does not guarantee linear price appreciation. Professionals separate long-term demand narratives from short-term price risk. Strong industrial use supports silver over long horizons, but price still depends on liquidity, speculation, and currency conditions. Volatility, silver's primary characteristic. Silver volatility is not a flaw, it is a feature. Silver routinely experiences price swings that exceed those of gold and broad equity indices. Professional investors account for this by using smaller position sizes, applying wider stop ranges, and accepting partial profits earlier. Retail investors often overallocate to silver during bullish phases. Professionals limit exposure so that volatility does not damage overall portfolio stability. Risk management: how professionals control silver exposure. Risk management defines professional silver strategies. Key principles include position sizing based on volatility, not conviction, predefined risk limits, clear exit criteria before entry. Silver is never allowed to dominate a portfolio. Professionals treat silver as a satellite position, not a core holding. This allows participation in upside while preventing catastrophic downside. Risk management turns silver from a gamble into a controlled exposure. Exit discipline: when professionals reduce silver positions. Exiting silver positions is rarely emotional. Professionals look for signals such as rapid price acceleration disconnected from fundamentals, excessive retail enthusiasm, futures market overcrowding, declining momentum despite rising prices. Silver rallies often end quickly.
Professionals do not wait for confirmation from price collapses. They exit during strength, not weakness. Scaling out is common. Portions of the position are reduced as volatility increases and upside becomes limited. The role of real yields. Real yields are one of the most important drivers of silver performance. When real yields rise, opportunity cost of holding silver increases. Capital flows toward yield-producing assets. Precious metals face pressure. When real yields fall, silver becomes more attractive. Hedging demand increases. Speculative interest rises. In 2026, professional investors closely track real yield trends rather than reacting to silver headlines. Capital rotation. Why money does not stay in silver. Capital moves in cycles. Professional investors constantly rotate capital between asset classes based on relative opportunity. Silver competes with equities, energy, industrial metals, bonds, and cash equivalents. When silver outperforms, capital eventually rotates elsewhere. Professionals anticipate this rotation rather than reacting after it occurs. This is why many professionals reduce silver exposure even while bullish narratives dominate financial media. Silver versus gold, relative value analysis. The silver-to-gold ratio is a common analytical tool. A rising ratio suggests silver outperformance. A falling ratio suggests gold leadership. Professionals use this ratio to adjust exposure, identify relative extremes, and avoid emotional positioning. In 2026, this ratio continues to provide insight into speculative excess and risk levels.
Impact on American investors. For U.S. investors, silver exposure affects retirement portfolio volatility, inflation hedging strategies, and commodity allocation decisions. Excessive silver exposure can increase drawdowns during market stress. Professional discipline protects long-term financial planning goals. Silver is used as a tool, not a bet. What may happen next for silver in 2026? Possible scenarios include continued volatility driven by rate expectations, short-term rallies followed by sharp corrections, capital rotation into other inflation-sensitive assets. Professionals prepare for multiple outcomes rather than committing to one forecast. Flexibility matters more than predictions. Silver as a strategic position. Silver in 2026 demands discipline. Risk management determines survival. Exit discipline determines profitability. Capital rotation determines long-term success. Professional investors do not fall in love with silver. They respect its power and control its risk. Silver rewards preparation, not emotion. In modern financial markets, that difference defines who protects wealth and who gives it back.